Yeah. So we've got to start a little early today. We got to end in an hour. I've got to, of course, you all know, got invited on the podcast with Andrew and Niels to talk about managed futures, trend following ETFs. So that's what we'll talk about. I just didn't have much notice, but I'm ready, and should be interesting and fun. Andrew and I are ETF CTA managed futures trend following brethren, and but we are competitors to some degree. Managed futures versus trend following. So I'll be sure to bring that out. And if you have any other interesting questions that you would like for me to, that you want to pose to the group, put it out there on Twitter, and I'm sure we'll get to it. We both have a list of things. His list is much different than mine, Andrew's that is. So it should be pretty fun and interesting and entertaining. I like Andrew, so no cage match, no wrestling, no getting down in the dirt like he did with Tim. But actually, I had a few things I needed to remind Andrew of all the benefits of his replication. So replicating 14 markets versus trend following 300 and 400 markets like we do, half of them being stocks. So much different. Gives people good options to build a portfolio with one or the other or both. I own Andrew's fund as well. You might imagine, not nearly as much of my own that I own. There was a couple of good tweets out there this week. Oh yeah, the paper from Mount Lucas, very timely from them, criticizing trend followers who have stocks in the portfolio. Pretty sure it was indices as well. Not sure. Probably indices and single stocks. Oh God, you can't get any worse with managed futures people than trading individual equities. Trend following. How dare you think trend following works on stocks? But that's coming from the trend followers. So that's not surprising. A little sad and baffling. But both him and Doug definitely mentioned CTAs are not very good at trading stocks, indices, and single stocks. Both of them are um, negative on that. And but the Doug from Florin Court, I really like him. He's a smart guy. Um, he has got a great business. I mean, I love his business, and it's trading 500 markets, and none of the markets are U.S. based or European based or mainstream. They're all alternative. So I found that to be pretty interesting. And he's going to be adding 50 per year. So he said the next time I'm on, maybe I'll have 700 markets. I thought that was pretty interesting. He goes a step further, or a few steps further. And not many people who talk about trading a lot of markets say this, but he says that his markets are superior markets. So not only are there more, but they're better. They're better because there's not too many speculators in those markets. They're off the wall, OTC. Some of the markets he mentioned, I trade as well. Sunflower seeds, white maize. Yeah, he probably trades cattle and corn from Brazil. But then a lot of them OTC, turkey stuff, turkey uh, cross rates, turkey bonds. I don't even trade the turkey currency because it's so illiquid and kind of unstable. And a lot of market makers, Forex desk will not quote that. Some of them will. They go in and out as well. Sometimes they will, sometimes they won't. Yeah, he probably stayed in Russia as well. We got out of our Russia. That was political pressure and peer pressure on that one. But those are three good things to talk about. The podcast coming up with Niels and Andrew. The no trading stocks from MLM, Mount Lucas Management, who's a competitor as well. They have a ETF. And then Doug Greenick. And anything else that you want to talk about, let me know. Okay, Oleg, out in the tent. Very nice looking tent you had there.
Hi, Boris. Hi to everyone. My technology gets better. last maybe 3 seconds. So I'm now I'm decided to spend some time, few days in the tent near the sea. So it's not very good connection here, but I have found the place where connection is better than in other places here. So I'm reading started to read the book of Marcus Aurelius. He was an emperor of Rome and Rome, and he wrote his book few 2,000 years ago. And I want to find something about our following principles in this book because I have seen already. I read this maybe a few chapters, and I have seen already that human behavior is not changing at all. And when I read this, I understand how consistent human behavior is, and it's a big evidence that our transform strategies are very, very highly, very strong. So, so I'm very happy to be here, and of course, even in such place, I have found where I can get a connection, maybe not perfect connection, but my connection not perfect even in the center of the big cities. So I'm very happy to be here. Let's get started.
Hey Jerry, hey Oleg, hi guys. This week I've tested few a different thing with my strategy. All right, I said, all right, let's. At the moment, I'm trading 30 commodities and 30 forex as part of a 150 market portfolio. So, and I said, all right, let me do what actually Neil suggests. So I've reduced these things to 10. So instead of having 30 commodities and the 30 forex, I've tested with 10 each and then 20 each. So instead of a 60 total, 60 combination of forex and commodities, I've tested my strategy with 20 forex and commodity, and then 40 forex and commodity. And then I've applied the same logic to the single name stock. So, to see whether what's gonna happen if I reduce the total number of markets, and of course I've increased the risk proportionately. All right, so the total risk budget didn't change, but the markets have reduced, and you know, and to my huge surprise, the results with just 10 commodities and 10 forex, the dollar pairs and the most liquid 10 commodities, and then 20 of them are almost identical. And I said, wow, you know, I wasn't expecting to be that close, but the results were that close. Now, when I included single name stocks and did the same thing with 10 stocks or 20 stocks as opposed to 75 single name stocks that I'm trading now, results actually break down. So with the single name stocks, this sort of reducing the total sample size didn't work. So my conclusions out of this test is, now, first of all, when testing with low number of markets, there's a huge reliance on the back test, because while testing with the back test, there's only opportunity, but while actually trading, there's uncertainty. Okay, so that's the main thing. That I said, all right, in the back test, these 10 instruments are making the same amount of money, similar amount of drawdown. So why do I have to bother trading 30 as opposed to 10? Because with 30, while my systems are engaging with uncertainty, okay, I feel much more comfortable that I'm going to get the nice outliers. So with the so there's less reliance on the backtest. So that's my first observation. The second observation is, as I have mentioned, this is breaking down with single name stocks because the selection bias is huge. So with the commodities and the forex, I'm only reducing the universe of 30 commodities to 10 and the 20 commodities. But there are, thousands of stocks, and instead of trading 75, when I trade 10 or 20, then the results compared to trading 75 stocks compared to 10 or 20 stocks is nowhere near. So there's the divergence between trading low number of single name equities is large. So that argument wouldn't hold. So that's why when many futures, professionals, when they say, you can get there with the low number of markets, it makes sense because those guys are not trading single name equities and their selection bias is limited. There's a limited selection bias with commodities and forex. So yeah, yes, I get it. Yes. So that's the second observation. And of course, the third observation is, you're trading with a larger position size. So in the event of a USD Swissy breakdown in 2015, you will get hurt more if you're going to go down the route of trading limited number of markets. So there's always a larger position size and larger risk of getting hurt due to larger risk per position, concentrated risk, basically. But so yeah, I just wanted to share this. It's just it blew me off this week. Thanks a lot, guys.
Thanks, Al. What do you mean by selection biased, and how does selection bias relate to, for instance, single stocks versus trading the bond futures, or the typical CTA would trade the bond futures or the currency futures and commodity futures? And is there selection bias there? And I guess there could be if they don't trade them all. Is that what you mean?
So basically, what happens is with the commodities, my universe is 30, so I reduce it to 10. Then with forex, again, my universe is 30 forex, and I reduce it to 10. Then with credit markets, I'm trading 15 markets anyhow, so there are not too many. So I didn't, I haven't touched to the credit markets. But with stocks, now, within S&P, there's 11 sectors. And, at the moment I'm, trading 75, a diversified 75 within those 11 sectors. And so what I mean is, trading 10 or 15 stocks makes the selection bias huge with the single name stocks, way more than commodities and forex, because there are, things move. So there is something else with this business, like sector moves. When grains move, you don't necessarily have, I figured you don't have to necessarily trade the soybean oil, the soybean meal, then in the corn, then the wheat, then the rough rice. So what happens is, if you do that, like I do at the moment, I'm doing that, your returns are smoother. But if, 2022 March happens, when there's a geopolitical event, the entire grain sector is moving. So if you're going to trade the more liquid one or two grains, then you're going to make money. You don't have to trade the 7. The same thing applies to the energy suit. Now, if you're trading a natural gas and a crude oil, you probably are going to make money when energy commodities are moving. And then the same thing applies to, softs. There are 4 or 5 softs that I have included, like the lumber, like the sugar, the cotton, the ones, the coffee, the usual suspects, I would say. So that's why I'm saying with the commodities, there's less of a selection bias in the backtest, though. This doesn't mean the future is going to look like this. So there's a huge reliance on backtest that I wouldn't necessarily be happy to take it. But naturally, the people who are trading 10 or 15 commodity markets with high risk are doing that. They're looking into their backtest and they're happy to engage with the future like that. So that's why there's a less uncertainty and the selection bias is smaller there, because naturally the total commodity markets are way less in terms of markets compared to the single name stocks, because in the consumer discretionary just alone you have thousands of stocks, and if you wanted to say, okay, I'm going to trade two stocks, single name stocks in the consumer discretionary, well, the chances are you're not going to make as much money. But if you're trading only crude oil and natural gas, the chances are you will be making a lot of money if it is making sense. Thank you.
Right. Yep. I think that's all of that is one of the reasons I only pay attention to trade stats, and the trade stats are less likely to be influenced by this bias. If you introduce the right the right group of stocks or the wrong group of stocks, along with your currencies, commodities, and interest rates, and you make them all, roughly like 25% each in your back test, let's say, then it's going to be hard to choose the wrong system, and that's the key. Did I choose the wrong system? Did I, because of this back test where I had too many stocks? And that's why I don't want to pay attention to the equity curve. I'm only paying attention to the average trade, the average win, the average loss, and the win percentage. And it's difficult to get some false readings if that's all you're going to take away from it. And I I don't really think I'm an expert. I ask all you experts about this selection bias all the time because I want to make sure at some point I fully understand. And I got a little bit more information from all of that. But it seems to me that also going forward, there could be this selection bias. And I think one of the ways to uh, limit this selection bias, I think, would be to have a fixed portfolio. Don't change the stocks, just like you don't change the currencies, commodities, and interest rates. I think CTAs, they want to trade as many markets as possible, given the size of their capital. And so it doesn't even cross their mind to kick out some of these markets. They're just continually adding to try to get above 20 or 50 or 100. But in stocks, of course, there are these thousands, and you could easily get rid of some, add some others, and switch back and forth if you had an ideal or relative strength thing. So I don't do any of that. I just kind of keep um, all of my markets constant, all the currencies, commodities, interest rates, and I chose my 150 stocks based upon not even looking at the back test. I only chose them. Uh, this is crazy, right? I only chose them due to my perceived level of diversification that they could add. People on Twitter have been asking me, how does Jerry choose these 150 stocks in the back test? And one person said, we kind of know what's coming with these futures markets, but we have no clue. There's 4,000 stocks. Now, come on. I chose my 150 stocks, my 150 futures, and it's pat. I'm standing pat with these, unless I'm long WWE, the Worldwide Wrestling stock, and that's merging with UFC. So I'm going to have to replace that stock. But yeah, you can do that, but I'm not taking them out, putting them back in with some sort of relative strength measure, which I think is no good, or some sort of other idea. I'm tired of losing money, so I'm going to take it out. This was Turtle 101, December 1983. You do not take markets in and out. There's no difference mathematically than missing trades. I'm not going to do the British pound this time because I've lost too much money. It's the same thing as I'm taking the British pound out or not doing the British pound trade this time because of any other reason. It doesn't matter what the reason is. The math gods do not know your reason. They just know that you didn't do it. And you had 5 losers in a row in a certain market. And now um, the next trade could be a really big winner, big, huge trend that you're going to miss because for all these good reasons, you took it out. So you don't want to do those things. You want to have more of a fixed portfolio. I never have heard any CTA or, well, almost anybody. Certainly that's not how real stock traders, quant trading, that's what the guy from Florence said. He said, oh yeah, if you want to get good stock trading, I know a lot of good stock quants, but not CTAs. So we're not even looking for the best stocks. What's going to move next? No, we have half my stocks I have in my portfolio are flat. I have some shorts. Shorts are very important. You can't just trade the longs. You have to have one of the ways you kind of know you have a good portfolio of stocks is some of them are flat and some of them are short. You don't have all longs. It's the same in the currencies and the commodities and interest rates. You don't want to have all these everything to be long or everything to be short. We love being long the dollar, made a lot of money. We love last year being short the bonds. There's more diversification usually in the stock market because it's very difficult to have everything long or everything short, unlike commodities, currencies, and interest rates. These stocks have these big trends. This was my defense. Stocks have these big trends. They have huge outliers. I participated in some over the past few years. Sometimes they're the only things trending. And if you sell your soul to this managed futures idea of I'm here on this earth for one reason only, and that is to be a small allocation from a traditional portfolio of long and short. I believe in long and short. I believe stocks. I believe in bonds. And I also believe in trend following. See, I only believe in trend following. So I think it would be great if people added me to the traditional portfolio, but also it's a better portfolio. And that's my main interest, me. I'm more interested in me than them. And that is I want to manage my money and my friends and my family and the people who love trend following with the best portfolio possible, and that's going to include a lot of stocks, strictly because they're great diversifiers. And I'm not going to uh, condemn myself to uh, creating a business and a portfolio that is just here for them. Yes, I'm here for you. Please give me my 5% allocation. And then they even take the stocks out. They take indices out um, because they already have them. I'm on this earth for one reason. So even they torpedo their own portfolio. It's worse. Some of the CTAs on Niels's CTA series talked about this, and no one said that it was better. It was always worse to take out markets. It's worse. The portfolio is going to be worse. I choose to make less money, to have a worse portfolio, because I want to help you, and I know what you want from me. It's just sad. It's sad. It's sad managed futures. I don't like it.
Hey, hi everyone. Glad to be here. Albeit the earlier schedule, but thanks Jerry for the extra effort, and thanks everyone as well. With this, I'd like to chime in this selection bias thing. First, I think we can never fully avoid this selection bias problem, and mostly due to data availability. And we can't really know how our portfolios would perform, I don't know, 80 years ago, simply because many of the futures we trade today were not available back then. And there is some kind of selection bias simply because that's what's available for us. But then we get to this universe, this almost infinite universe of stocks to select from. And what makes me feel a little bit more comfortable about this is the results I find in my back tests when I compare the trade stats isolated in each market. When I see what's the hit rate for lean hogs, it's similar to the hit rate I find for I don't know, live cattle. That's the similar for crude oil. That's the similar to 10 years treasury bonds and anything. The win-loss ratio pretty much the same as well. So my point is, it doesn't really matter in the longer term which markets you're choosing to trade. Now, and please correct me if I'm wrong or if you think differently, everybody. But where I think there is a difference and it makes a difference, is if you're trading only one market, you're going to have that trend following return profile that you're expecting. The thing is, it may take a lot of time for you to see that portfolio developing the way you hope to. Whereas if you trade a lot of markets, you're giving your portfolio the chance to develop as you expect in a shorter amount of time. The way I like to think this is, if you're trading only one market, is as if you have a line that you have to run through, and try each trade as time passes, and you go across this line. If you have more markets, it's as if you have parallel lines and you're running through all of them at the same time. So you have an increased chance to see that outlier trade to outperform or to flourish within your portfolio in a shorter amount of time, simply because, well, if there are more markets available for a portfolio to choose from, you will have an increased chance of that at least one of them will be that outlier.
Hi guys, can I ask you a question about trade stats? When you analyze those trade stats, I guess that you analyze the evolution of those trade stats. So how do you classify the trades in terms of when they started, when they lived, or when they ended, or something like that?
Well, I'm not sure I understand the question, but basically, I look in things in terms of ATR. So I get rid of the compounding,
No, no,
and it just so
Cherry,
happens.
sorry. I mean, when, for example, you want to know how the trade starts are evolving. How do you classify the trades in the date ruler, in the date axis, so to speak? When they started, I mean, on the opening date, on the closing date, or I mean, an average, or how?
Yeah, well, you have to wait until the trade's over, and I ignore everything in between. So,
So close trades.
and I, yeah, close trades. Sorry. Yeah, yeah, of course. Close trades. You ignore the open trades at the end of the run, and you ignore I mean, we print out an equity curve. Don't get me wrong. We see that equity curve. Whoa, look at that drawdown. We see all of that. But we run these stats, and I look at this on a daily basis on all of my open trades, like in terms of ATR, right? So everything is normalized. So what was my max profit? What's my drawdown today? What's my max drawdown? What could it possibly be? And I'm really interested in that. I mean, I close my eyes because we have these built up profits usually. They're so large, and the potential drawdown could be so huge. But yeah, I mean, I think, and then we sort of look to see over time how they change. They probably were juicier, better trade stats early on. And, of course, they go through lulls where you have the lost decade, and that the trade stats, they suffer a bit as well. But yeah, I think the trade stats are really good because the goal is what? The goal is to choose the right systems to trade. And as I've said before, when I run my systems on the back test, well, number one is, I got to be careful compliance wise, but in the back test, they seldom have a losing year. That's right. Like 30, 40 years, seldom have a losing year. Were you paying attention to that equity curve? Yeah, I am. I'm looking at it, but I'm not altering my systems based upon Sharp or these drawdowns. I'm only saying, okay, I like that. If I'm sitting there suffering with all of these drawdowns and all this volatility, no smoothing, no dynamic position sizing, correlation volatility smoothing, then golly, thank you for giving me this one thing, which is consistency. That's nice. But the trade stats, yeah, I think they're more reliable. They're kind of more stable, and you get a better indication, better idea of what to choose. And then when you run them over all these different choices of parameters on these breakout systems, my research shows that they all make the same amount of money. The trade stats are a bit different. So the average trade on system one, which is shorter term, is less because it does more trades. In system four, which is really long term, it doesn't do as many trades. The average trade is a lot larger, but they all make the same amount of money over time. And for some reason, that makes me feel really good. So, and they're really highly correlated, during the trends, but less correlated, as we've talked about over the past few weeks with Richard, on each individual trade. The P&L in a certain trade, and especially if it's an outlier, will be different because the give back is huge, and the give back on System 1 is less than System 4, and System 4 can give back a lot less. But if System 1 gets out, System 4 doesn't, and it's going to be a big difference. But if System 1 gets out and it goes back to new highs, and System 4 never got out, then System 4 is going to look a lot better. So that's what you get from this parameter diversification is, and I've just totally optimized it. Totally 1,000%. I trade the most profitable systems out there because I optimized and I chose to trade those, all four of them. And I could trade 8 systems if I wanted to, and they would all have the same historical performance. And that is, and then I only the only risk metric is how much I'm risking on the losers. So they are the most profitable, but they don't have great Sharpe ratios. And that's another thing that Doug from Floor and Court said. He said his strategy, which is trading these alternative markets, and he called other CTAs developed markets CTAs. I love that. I love that. These digs that these people get into. Everyone, I'm an alternative market CTA. Everybody else is developed market CTAs. He says that the Sharpe is so much higher and the markets are so much better. And then he says something like, I'm only interested in robustness. And then he goes on to describe, I tried to make fun of this, all of the non-robust things he does, which I thought was pretty funny. But yeah, these guys are totally interested in Sharpe. And that's anti-trend following. And then he goes on to say that he just wants to be the world's best, purest trend follower. Although, today they describe themselves as the purest by having fall control, correlation control, dynamic position sizing. So it's like 1984. What I say, I can redefine things. They're redefined things. So one entry, one exit, and a stop loss. They'd probably call that kind of like caveman, and all the other stuff that they add to the trend follower now can be described as pure.
I think we can't, any person cannot tell that he is a pure trend follower if he violate our core principles. And I think, first of all, it's risk management, it's diversification, and our philosophy. And of course, it cannot be such games with all things I have said before many times. It's my own opinion, but I'm sure that it's so. And I see how I have said this maybe of times, but this classical following program strategies work so good that I really don't understand why people do this and other things like bulk target. I understand that they want to attract more investors, they want it to move smoother, yes, but it's a downside of this, and sooner or later the person will see this downside. I think, and I'm wrong here, but I think it's some kind of warehouse and risk and so on. So I think, and about, we were talking about selection bias today. I think that if, I have said before this, if your capital is limited, there is some sense in the selections to select some commodities that uncorrelated, but it's of course it's not perfect decision. It's not perfect, but maybe you must just know how we can to select, for example, cattle and United States dollar in the end, for example. So here is my point.
Jay, you mentioned you're doing these back tests to be able to understand the best systems to be able to trade instead of looking into the equity curve. I mean, what does best system mean for you? Is it, are you looking at the the maximum MAR ratio? Like, are you optimizing for that, or what do you constitute as best systems? Thank you.
That would be one of those questions I would have to say that I have answered even today. So I haven't been that clear. But so I just look at the trade stats, and the problem with looking at all of them is now I'm used to understanding what's going to work, and so they're never objectionable. So I look at them, but they're always good. I know not to go too short term. And I know that in some respects there's no reason to go longer term than I am already going. I could go a bit longer term, I think. So essentially, it's just the average trade. I want that average trade to be very high in terms of ATR, 3-4 ATRs per trade. On average, I'm going to make 3 to 4 ATRs. And when I run the back test, every system has the same stop loss. So I'm looking at this win ratio, the average win divided by the average loss. So yeah, that's pretty much all I'm looking at and I'm not paying any attention to drawdown from the open trades. If I got a really low win percentage, that would shock me a little bit, but they're all going to be around 40. And if I got a really low, if I looked on the equity curve and saw that there was a period where I had a lot of losers in a row, I would probably ignore it and just say, well, yeah, of course, if you look at enough data, you're going to see this. And if I looked at the equity curve and saw, or the trades, and saw that I never had a lot of trades, losing trades in a row, I would expect to have them. I'm not going to pay very much attention to any of the specific historical movements and what this equity curve looks like. I'm automatically going to trade smaller and think, oh, it's going to be worse than this. But I am going to rely a bit on my selection process. Once again, selection process. This is the only benefit to this backtest is how we're going to trade. Not we can rely upon this thing. We don't have to have other things. The cutback rule, other money management things. Of course, the massive level of diversification I'm willing to go through. Totally unnecessary. Sure. In the past, totally unnecessary. I need more markets. I don't care about the past. I'm going to leverage this loose pants, juicy average trade, really nice win-loss ratio, and be very conservative with my trade level selection. My trade level is always a good distance below my actual AUM. And I could be leaving money on the table, but I feel very comfortable of focusing in on just protecting that capital and using that capital as my trade level. And as I've said before, in my long-term systems, any drawdown that I had in the closed trade equity, the capital, was less than the current open trade equity. So essentially, I could have closed down my account any day in the past 40 years, and the drawdown in my capital would have been absorbed, would have been totally taken away by the open trade profits that I had at any point in time, except the first couple of months when you first get started. But once you build up these, you have a tendency in the back test to continue to build up open trade profits at a higher rate than you're chipping away at your capital. So yeah, that's why I fell in love with this whole strategy. It's all one big ball of wax. You've got to include all of these ideas in there, not just the long-term nature, the loose pants, the breakouts, the sizing, the trade level, the cutback rule. You got to build it all in there together for something that's going to preserve that capital. And it's really cheating for us to, because I have to put myself in other people's position and make arguments against me because they're not usually willing to engage in these discussions. So yeah, you're cheating, Jerry, because anybody who doesn't pay attention to Sharpe and volatility and classifies their capital as closed trade equity, I could do that all day long if clients would let me. And I'm like, well, you need to get other clients or educate your clients that this is the best and safest way to preserve capital and not impinge upon your ability to make a lot of money.
Hey, Jay, just one quick question. In terms of trading the single name equities, what is your view on actually forming two portfolios? One, one system is just going to trade single name equities, and the other is just going to trade the usual classic trend following markets with the commodities, credit, and the forex. So why you have built your system to warehouse everything else in one system instead of dividing these systems into two and potentially trading perhaps, let's say, 5,000 equity markets in the equity system, because there are so many equities, even 300 is quite, is a good diversification, but there's no reason why that diversification could be a little higher if you would just focus on one system to the single name equities only instead of combining those two systems. Am I able to explain the question well?
I think so. I mean, I think as a marketing and a business idea, and this is one of the things that KLM or Matt Lucas wrote in their article. They were criticizing people like me and giving us these bad motives in why we trade equities, because people like equities. You can create a bigger business with equities. It's all these bad motives that we have. Where my motive is the perfect portfolio, more perfect. I mean, I'm not capable of creating the perfect portfolio, but I can do a better job on what I can achieve by adding single stocks. But I think I don't care what the performance of stocks is. I don't care how many lost decades we have as CTAs. I never would think that stock only portfolio is going to be better than a fully diversified portfolio, and diversified to the extent that if you can trade a lot of stocks, then stocks can be more than 25% of your portfolio. There's no magic number. I chose 50%. That might be too much or maybe too little. It all depends upon what kind of diversification are you getting from those. You have a lot of stocks to choose from. You have 50 commodities, 50, 60 currencies, 50, 40, 50 interest rates, 5,000 stocks. Right there, you're thinking, okay, all right, I don't like it, but I could see how you might think you could do more stocks than 25%. Okay, that's all I'm saying. So, but I don't care what the historical performance says. It's going to be better to have a diversified portfolio. But some people prefer stocks. You can make a lot of money. It can be your second ETF if you wanted to. And hopefully you can get some shorts on most of the time. But in all these sectors, you're going to be long only, short only sometimes, and you're going to make a lot of money if everything's going up, if you're in a big bull market, or if you're short everything like 2008. But you're going to regret it because you'd prefer to have a little bit of some shorts on, and you can't always do that. So you're going to be vulnerable to those givebacks. So that's kind of a bummer. But I would do it if there was demand for it. Maybe that's what the second ETF will be, stock only. And it may be a bigger ETF. People love stocks. We try to tell people about how great it is to trade all these markets, other markets, long and short, and they probably won't listen. But Billy Groh sent me a screenshot of Andres Clenau, a page from his book about how trading stocks is a bad idea. That's a quote. And the problem with that book and I've talked to him about this, and he basically compares trading stock only trend following to diversified trend following. Yeah, of course. Give me a break. Don't write a whole book and with a title that makes people. Yeah, because I'll write a book saying trend following on bonds is a bad idea. Then my second book will be trend following on commodities only is a bad idea. And then third one will be trend following on currencies only. Yeah, and only is a bad idea. I don't like only. You're talking to a person who has the most diversification humanly possible, other than Floor and Court, or maybe others, right? I mean, I don't know. Who cares? I don't know. I'm doing the best I can do, and I don't have his ability. And his business model was so cool foreign courts, that is, in that he said, like, what we really offer, I don't have fancy trend following systems, although it sounded like his were way too fancy. Um, but what I do is it's a lot of hassle and hard work uh, getting these 500 markets, going and talking to brokers and market makers, and finding these, a bunch of markets in Turkey to trade over the counter. And I was like, that's a hell of a deal. That's he's earning his incentive fee because it's really hard to do. I don't think it's possible that his markets are better trenders, but for another day. But anyways, back to your question. I think, yeah, trend works well in stocks. Short stocks, it's the worst of all the sectors, and but you have to do them just like short currencies, commodities, and interest rates are not overall usually that great as overall not that great. We have some good periods, especially last year in the bonds, but yeah, you want to be as fully diverse as you can and build this portfolio to make it as diverse as possible. That's what I've tried to do. And then you get this more outliers spread out throughout the equity curve, not bunched up like if you only traded 50 or 60 markets. And then you have this small bet size. Then you have a story to tell too. Maybe it's just mostly about the story. I don't know.
Hey, everybody.
Hi, Moritz.
Oh, hi there. Yeah, it was. I really wanted to come on, but I thought it's 2 p.m. my time, so I'm kind of like I just got surprised. I picked up the phone and got a notification by Twitter that you guys are already on. So I missed it. Sorry. Yeah, doing fine. Interesting couple of trading days. Not sure about you guys, but I had a pretty good start into the month of July. Kind of like the first 2 weeks were nice with bond prices going down, short-term interest rates still going down. Essentially everything kind of worked, and then it turned around. I'm a little bit negative now month to date, but nothing big. Maybe 80 to 100 bips, something like that. So not a big problem. And then these massive moves in the grains. I mean, this was interesting. You probably felt that in your portfolios. I'm not sure what yours all position is on like, corn, for instance. I got maybe a week or two ago, something. I was long corn for the most part, and then the system told me to go short corn, and obviously we had this massive spike the other way. But I'm still short most of the like wheat, Minneapolis wheat, and milling wheat here in Europe. Those are all short positions, and they're making money today. So kind of like, I would say, normal type of trading stuff. Yeah, I did email Jerry about this Mount Lucas fund and the reasoning that they said or put forward as to why they're excluding the equities, and I didn't really follow that, to be quite honest. I don't follow the argument or the logic to say that equities, they're issued as an instrument for, obviously, once it's issued, somebody has to be the owner of that piece of stock. So clearly the market is long, right? But that, I think, is also true for bonds. Once a bond is issued, somebody will hold it, and therefore the overall market is 100% long. You can use the derivatives markets, futures, for instance, to hedge risk in the same way, so interest rate risk on a bond, for instance, in the same way that you can hedge directional price risk through equity index futures or equity forwards, or all sorts of things, options. So if they're saying, we're excluding equities because it's kind of like this long only one-way type of market that exists without any commercial interest, then logically they should also exclude the bonds. No, they don't want to do that. That this is kind of like you're killing your golden goose, giving up the bonds. That's not good. So I just found this argument, I didn't get it. And I was looking at David Drew's business Tactical, because I remembered that he also doesn't trade the equities. And I had a look at his disclosure document in order to see if I could find any explanation as to why he's not trading these markets, but he didn't offer any. There's nothing in there. But he as well doesn't trade the stocks, and I just like I don't want to get too carried away by that. To me, it's an instrument, it's an asset. It moves up and down. It's liquid, and I can therefore apply a trend following trading strategy that takes a small loss and has the potential for a big outlier move, long and short in these stocks. Why would I not do this? I mean, don't overthink it. It's a market that's out there. It's available. It does have diversifying properties in your portfolio. That to me is really the stuff that matters. So yeah, I don't buy the argument that they brought forward. Not sure about whether you discussed that already. Hopefully, I'm not boring you with my monologue here.
No, that's great. I agree. Stocks have trends. We had a lost decade, and it was due to trends in one sector of the market that CTAs don't trade the correct way with the best potential markets that are going to give them the best potential outliers. So I think it's just another way of saying we talk to people and we told them we know our place in life, and it is a 5 or 10% allocation from the big guys, the man. I thought my tweet calling it the man would get more. Maybe it's an American thing, but I thought I'd get some laughs. But yeah, so they know their place, and we fit in. I think John Henry may have used to do this too back in the 90s, with this whole marketing slogan and idea of CTAs are here on this earth for one reason, and that is to be a small allocation traditional portfolio, and they want to fit in better. And there's some other CTAs that Niels talked to on his podcast that are de-emphasizing max budgets. They're de-emphasizing stocks and having a max budget in stocks to kind of move in that same direction. I don't want to be managed futures. I just want to be trend following as many markets as possible, trend following everything and trend following alone. No other strategies, but trend following as many markets as possible. And I would definitely trade China. I would definitely trade those exotic markets from floor and court if I could. I can't, so this is my best idea, which is to try to find a diverse group of equities. Hey, Richard, how are you doing?
G'day, Jerry. G'day, everyone. Sorry for my late entry. I was sort of caught napping on this one. I was looking for the next series after Succession to keep us going because after Succession ended, my wife and I, we suffered this sort of post-Succession trauma. So I started watching this Hijack, and I was in the middle of an episode of Hijack when I thought, God, Jerry's on, and I thought this is early, and so I jumped on. But sorry about my delay. Yeah, look, I'm sort of in the passenger seat at the moment, just catching up with what you guys are talking about. Jerry, I really liked your podcast you did with
Jeff Malik of RCM.
That's it. I really enjoyed that one. Loved your broccoli message. That came through strong and clear, and no, it was an excellent one.
Yeah, thank you. So anyways, I got to cut it short today because I'm going on with Andrew and Niels, whether we're going to record. And I just gave out some false information. I thought my buddy here asked me, when are we going to post this recording? And it's going to be, of course, Twitter Spaces posts something as soon as it's over. Richard posts something a few hours later. And then, but he was asking about Niels, and I have no idea. It usually comes out pretty quickly. But
it's getting quicker these days. Maybe tomorrow, probably.
Yeah, hopefully. So I've got to run, but if you have any good questions or ideas that you want to send me soon, make it quick.
Give them hell. Give them hell, Jerry. It's about time you sort of got the picture right, and I wish you all the best. I think Niels is waiting for you with a few questions.
Yeah, I'm looking forward to that one as well. This is going to be magic.
You will not. I want you to take a guess. You will not, but you will never guess this request I got from Niels just a second ago. It is outrageous. He just
come on,
requested.
Share.
Yeah. He made this most outrageous request, and of course, as a gentleman, I said yes. Of course, it's your show. I will follow your rules. But now he has the new rules. Here goes. I hope you're all sitting down. No birds allowed. What?
Oh,
No
And
birds
fighting
allowed.
words.
And not only that, I said, well, oh, no problem. PD will not be offended, but he spelled PD's name wrong. And I'm like, okay, can you please just spell her name correctly? So, anyways, that's how we're starting off. It's already contentious. It's going to be 2-1. It may fluctuate. I'm on Andrew's side, but then Andrew has managed futures. So I don't know. I don't want to gang up on Niels. I think 2-1 against me is a fair fight. Maybe they need 3-1. So,
yeah.
yeah.
Hey guys, before you go, I wanted to share one thing. I listened to the Corey Hofstein podcast with Doug Grenick from Flooring Court this week, and I thought it was an excellent podcast. And once I was done with it, I felt like this Doug guy, he is so good presenting his idea, explaining things like so convincing. Like I almost got carried away. It's like, he really gets it. But then I found myself thinking, because he's so adamantly saying that these markets that he's trading 800 now or 700 or something like this, so it's this crazy number of markets, and that these markets are so much better in terms of trending behavior than the stuff that we trade. And when he was done, I just thought that, well, what if he's making that stuff up? I mean, who's actually checking on that? So I'm proposing to you if maybe we can
And what's this
collaborate on that
too
as a
sharp? He's got a
yeah.
too
So
sharp.
well, no, I think he said 1, but I mean, maybe we can work on that together. If to the extent that we can get our hands on the data, I'm not saying that we're going to be trading these markets because, for instance, I'm not operationally set up to trade them, nor do I want to trade them at the moment. I'm too small to do that. But I'm intrigued, like if I could get cross-currency swap, Turkish lira, whatever, the Colombian interest rates, all that type of stuff that he trades, I think I could get my hand on some of the data. It doesn't have to be 100% precise, but I'd love to understand better what the actual diversification benefit of these markets is. Like, are they really so much better than the stuff that we trade? Maybe not, but I don't want to just nod my head and say, oh yeah, Doug is believe him only because he said it so convincingly on the podcast. He may have had 2 just maybe lucky years, and good for him maybe, but see what I mean? It's like I'm not entirely sold on this stuff yet.
Yeah, we talked a lot about that before you got on, Moritz. We need to keep it going. I tweeted a lot about it, and I would love to talk about him next week. So, okay, I'm 2 minutes
Okay,
late.
right, cool, all right.
You guys take care. See you next
Best
week.
of luck.